Hi, this is Samuel Madrid, and I thought I'd talk a little bit about my experience with private lenders when I'm talking to private lenders, asking them if they would be interested in possibly doing some private loans, some loans for real estate. Generally when I talk to people about what I'm doing, I always ask people or tell people, "Hey, I'm looking for people that want to partner with me in real estate." And generally, I explain to them that I'm a landlord, or I also do a lot of owner financing, and I do a lot of business with private lenders looking for people that are interested in real estate and interested in receiving cash flow on their dollars secured by real estate without the ups and downs of the stock market. And I generally tell people, explain the process that I'm looking for people that want to partner with me. In a way, they are partnering with me because the vast majority of the monthly payment coming in, going out to the private lender, is going to be part of their interest payment or their interest payment. And then there's a portion of the incoming payment that's going to be for taxes and insurance. And then the rest is going to be my cash flow. So in many ways, they are partnering with me. And I tell people that, I'm looking for people that are interested in partnering with me in real estate where they make the loan, they would receive the interest on their investment, and I would be the one responsible for the tenants, for the maintenance, for the collection of rents, for any evictions or foreclosures, for the property taxes, and for the insurance. And I explain to people that after the term of the loan, which for me is generally 5 years, I would either, if it's an owner finance deal, I would have a note created and I would sell off the note to get the lender underlying payment or the lender paid off. Or if it's a rental, I would go refinance the property, pay off the lender, and have a bank loan on the property, and it would be amortizing at a lower interest rate. So I also get questions from people on prospective investors on how they could get hurt. What's the worst case scenario? And I've always explained to them that, they're going to have a first lien on the property. They're going to have a deed of trust or a mortgage. In Texas, it's called a deed of trust. They're going to have a promissory note describing how their payments are going to be made. They are going to have a promissory note describing how their payments are going to be made, the interest rate, the monthly payment, the term, how long the loan would go on for. They're going to have a fire policy naming them as the mortgagee, which states that if there was a fire, they're going to be the first ones to get paid. And then any equity in the property after their loan would come to us. So they get paid first and they're well secured. And then they also ask me, well, what happens in the event of a foreclosure? And I always tell them, well, I've been doing it for 25 years and I've never had to give a property back, and I've never had a foreclosure. But in the event of a foreclosure, they would foreclose. It's very easy to do in the state of Texas. They would use the deed of trust. They would find a local attorney to do the foreclosure. And then if it was me, I'm going to go look for either a real estate person, a realtor, who would list the property and sell it on the MLS, or I'm going to go look for a wholesaler that possibly would just give me a cash price and get the property sold in a very quick amount of time, a short period of time. So in my mind, there's very little risk, especially when you're keeping the loan to value at about a 75-80% loan to value. So as an example, if you had a $100,000 loan and, $100,000 property that valued at $100,000 and you made a $75,000 loan, that would be a 75% loan to value. You're well secured. You have a lot of equity still in the property in case of a foreclosure. What else could go wrong? They've also asked me, or I've been honest with people, I tell them, they always ask me, well, what's worst case scenario? In my mind, for me, worst case scenario would be something were to happen to Sam Madrid. I'd get hit by a car, I'd be in an accident, and then they would have to deal with the properties. However, I have an office. My office has a staff. I mean, my staff knows exactly what to do. They would continue to make the payments. My wife, my kids would take over the mortgage, the payments. But in the worst case scenario, I did have one investor who made a large amount of loans to me, and they asked me to get an insurance policy, a life insurance policy, naming them as the beneficiary. I did that. And we got $1 million policy, or I already had $1 million policy, and I went and named them as the beneficiary. That was a larger loan. That was something that made them feel comfortable, and I felt comfortable too. If something happened, they would be paid off. The balance of their loans would be paid off, and then my estate would own the properties free and clear. So, in a nutshell, I think I know private lending is a great way to invest money without the fluctuation of the stock market. It's consistent, positive cash flow. I call it mailbox money, going to their mailbox. And it's a great way for people to invest in real estate without having to get their hands dirty. So I hope this was helpful. Bye-bye.